If you look back, the S&P 500 just closed out its best streak in more than a decade. Nearly all the forecasters polled by Bloomberg now think more good times are ahead. Deutsche Bank's Binky Chadha is most bullish of them all, predicting a 23% gain this year. He was one of the most accurate forecasters in 2010, saying the S&P would end the year at 1275, just a few points off at 1257 there. Binky joins us here now in studio. So, Binky, at least in the first trading day of the year, the optimists seem to be in your camp as well here. Well, what is it that you think is going to really drive the push into equities?
Yeah, I mean, I think there's two ways to think about it. I think the important backdrop you have to keep in mind is that the strategic or longer run case for equities, in my view, is very, very clear. If you look at equity returns over long periods of time, they tend to follow these very long cycles. And despite the run-up since March of 2009, we are very close basically to a long cycle low, which argues for very strong medium-term performance. Equities are very cheap, both on an absolute basis, and I would argue most importantly on a relative basis relative to other asset classes. In terms of basically the tactical drivers for the strategic and longer-term case, there's a long list of them. I would say key among them is, when will we basically see a reallocation back into equities? I think the case is not if, the case is when, and our view is it will be this year.
Well, so you think, because we've been waiting for companies to spend cash and for a retail investor to hop back in. We've been talking about this for a year. Does that now happen? I mean, do you really think that the Main Street investor gets the kind of sentiment that you're talking about economists seeing?
Sure. Historically, in every business cycle, we have seen a reallocation back to equities once it's clear to the market that the recovery is self-sustaining. And even more importantly, I would argue that, there is a general belief that rates have put in a bottom for the cycle. I think, what we are seeing right now is very early stages of that, and that's partly due to the peculiarities of this cycle where we saw a massive QE2 trade that basically took rates down, and then as QE2 was implemented, we've seen rates go up, and that has, seen some reallocation basically back to equities. I would say, we are very, very much in the early days of that reallocation process, and it's got a very long ways to go.
We're joined now by Binky Chadha, Chief U.S. Equity Strategist for Deutsche Bank. We were talking before the break about your optimism in this new year. Today's session, you're looking at energy, tech, and financials climbing. You're feeling good about the financial space.
Absolutely. The financials, are very cheap. They're the second cheapest sector in the S&P. Healthcare is the cheapest. But I would point out that, if you look at basically all of the 10 sectors in the S&P, on an absolute basis, they're really all cheap.
But is cheap really a reason to put money into healthcare?
We don't think so, not just yet. I mean, the second point I would make is if you look at sort of the dispersion or the variation in valuation across the sectors, it's actually at an all-time low, which suggests that basically investors so far have really not been discriminating. So if all sectors are cheap and the dispersion across sectors and valuation is very limited, we think, pure value strategy is really not going to work. And what is going to matter is really what happens to margin and top line. And here, if you look at the defensive sectors versus the cyclical sectors, you'll see that basically top line for the defensive sectors, so sales are basically already past their previous peaks, whereas for the cyclical sectors, we're seeing a very, very strong recovery, but the level is far below sort of normalized or trend levels, and so the upside is much, much greater, which argues for being long, really, the cyclical sectors, which is how we are positioned, basically.
If you can get those sales to follow through there. On the financial space, what jumped out in your analysis is the number that you put on the cost of mortgage putbacks. You put it at $36 billion for the year for the financial industry, and you characterize that as conservative. B of A put, $2 billion on that today with Fannie and Freddie. Does that change your estimate?
No, I think that the B of A number is very much in line with expectations. I think the good news here is the speed of resolution really of that issue, and I think that's positive for the space.
So the fact that they are getting that behind them in some sense makes you think that perhaps the worry's been overdone?
It's a question of, not really that the worry's been overdone, but for how long basically that cloud is going to hang over. So, speedy resolution is very, very positive because it's another cloud that passes, basically.
And the story with the financials is also you're going to start seeing dividends and dividend rates pick up, being paid to hold the stock. You see that happening in other sectors as well?
I think that payouts are going to increase, across basically almost all of the sectors. I think the key for the financials is really when the labor market turns in employment, and we think that the same sort of rates of growth that we've seen over the course of next year, starting especially in the second quarter, should translate much, much more basically into actual jobs growth, because the work week is going to get back up to levels it was at the prior to the financial crisis. And so the brunt of the increase in labor input is going to have to come from employment rather than hours. And we see that basically the work week rising through the first couple of months of the year and getting back basically up to levels it was at before the recession, at which point increasing growth basically, or growth is really going to have to come much more from employment.
You say that the worries that we've been hearing about state and municipal governments being able to essentially pay their own bills, you think there's been too much concern on this front?
No, I think the concern is warranted, and typically, the third year is when that concern peaks, so it's not atypical. But I would argue that the key thing to keep in mind is that their revenues have turned up, so the key fundamental from a medium-term point of view has turned, and that means...
The amount they're taking in from taxes is making you feel a little bit better about it.
Exactly. All revenues have started to turn up, and that's the key medium-term fundamental. It doesn't allay basically or put to rest any of the near-term risks, because being able to meet your liquidity needs is a non-linearity, and it's a barrier that you don't want to hit. So, but the key medium-term fundamental is improving, and that should basically ease investor concerns, and so the liquidity should be there.
So you would put money into munis?
We are very underweight fixed income, largely because of where we think the pressure for treasury yields is going to be to go higher and much higher from here.
But you're feeling a little bit more confident about it, but you wouldn't choose to allocate around those. You think equities?
No, I think this spreads will be fine and should actually narrow over time. But I think that on a total return basis, fixed income is not where I'd put my money.
All right, Binky, thank you very much.
Thank you
for coming on, starting us off on a positive note for the new year.